Many new traders may have mastered the basics of using moving average strategies, but struggle with consistent profitability due to ineffective use of trend lines alongside moving average indicators. Given the numerous swing points visible on charts and the dynamic nature of moving average lines, traders often find themselves uncertain about where to place trend lines to determine optimal entry points. This video offers a clear, step-by-step guide on effectively combining EMA and trend lines in forex, stocks, commodities, or any financial market to achieve reliable profits. By the end of this video, you'll be equipped to identify high-probability trade entries using the exponential moving average indicator in conjunction with accurate trendline signals. We'll illustrate these concepts with practical examples from real markets. The goal is to fully grasp and leverage this powerful trading strategy. If you'd like to see more content like this, please like, subscribe, and hit the notification bell to stay updated on our latest videos. Before we begin, it's important to note that everything discussed here applies to currency trading, stock trading, and cryptocurrencies. Price action analysis remains consistent across different assets, and we'll delve deeper into this in the video. What are the benefits of trend lines? Trend lines are invaluable for identifying market rhythm. When price action breaches a trend line, it signals a shift in momentum and balance of power. This isn't a comprehensive tutorial on trend lines, but for a deeper dive into drawing them, check out this video. I'll provide a link to the full tutorial on trend lines at the end of this video and in the description below. On this chart, you'll notice a downtrend line connecting the peaks on the left. This line represents the long-term trend. The red line connects the recent swing low. According to my rules, I use the swing lows or highs to draw this line. A break of this line signals a potential change in market conditions, offering a level of insight that other indicators may not provide. So, what should you do when you encounter a signal like this? Simply put, a breakout above the red line, as seen here, suggests a tentative buying opportunity. Conversely, a breakout below indicates a potential for selling. A breakout above or below the long-term line, or black line, confirms a trend change based on price action. That covers the essentials of using trend lines in the context we're discussing. Combining 50 EMA and trend line for trading strategy. Trend lines help us gauge market rhythm, and when that rhythm shifts, combining them with moving averages gives us insight into trend direction and entry signals. Here's the same chart featuring both a trend line and a 50-period exponential moving average. Trend reversal trading. Before diving deeper into real market trading strategies, it's crucial to grasp the fundamentals of trend reversal trading. So, what is a trend reversal? A reversal occurs when the overall price trend changes. First, an uptrend shifts to a downtrend. Second, conversely, a downtrend shifts to an uptrend. Here's what a reversal typically looks like. So, what should you do? When facing a potential retracement or reversal, you have three options. First, hold onto your position, risking potential losses if the retracement evolves into a longer-term reversal. Second, close your position and re-enter if the price aligns with the prevailing trend again. However, this approach may result in missed trading opportunities and additional costs due to spreads. Third, close your position permanently, which could lead to losses if the price moves against you, or significant profits if you exit near a peak or trough, depending on your trade setup. Choosing the best option isn't always straightforward, as reversals can occur unexpectedly. That's why employing trailing stop-loss points is a valuable risk management technique when trading with the trend. It helps secure profits and ensures you capture gains even if a long-term reversal occurs. Trading rules. At first glance, this strategy may appear straightforward, but it's actually quite advanced. Techniques like these are typically covered in courses on price action trading for stocks, forex, and crypto markets. So, it's important to carefully follow each step of this explanation to ensure you don't overlook any details that could significantly impact the effectiveness of this strategy. Here are the rules for entering a buy trade. Let's go through the trading strategy step by step. First, start by applying an exponential moving average, EMA, to your chart with a look-back period set to 50. Second, draw trend lines that are relevant to ensure you have both a longer-term and a shorter-term line. Third, we're looking for a clear break in both the market's rhythm and the direction of the trend. Once you have the trend lines and EMA on your price chart, first, watch for an early indication of a setup with a break of the shorter-term trend line. Second, price should break above both the moving average and the longer-term trend line. The order doesn't matter. Reviewing the chart on the left side, you'll notice that the price did break above the moving average and closed above it. However, this alone doesn't signal a long setup. Both the moving average and the trend line need to be violated upon close. Moving to the middle of the chart, we find our setup and trigger rules in play. First, price breaks the short-term trend line upwards, which alerts us to a potential long setup. Second, price breaks above both the moving average and the trend line. The close should be above both. Third, traders can enter at the close or place a buy stop order above the high of the trigger candlestick. Fourth, place the stop loss at the recent low point. This is one of the most powerful trading signals on the market. The most important thing is that both the long-term and short-term trend lines are clearly formed. You shouldn't force a trend line if there's no clear price swing, or if it isn't formed perfectly. Here on this chart, we can clearly see the formation of both the long-term and short-term trend lines. If this formation is perfect, then when the price breaks both the long-term and short-term trend lines along with the 50-period EMA line, it's highly likely that the market has truly experienced a trend reversal. Here are the rules for entering a sell trade. First, start by applying an exponential moving average, or EMA, to your chart with a look-back period set to 50. Second, draw relevant trend lines to ensure you have both a longer-term and a shorter-term line. Third, we're looking for a clear break in both the market's rhythm and the direction of the trend. Once you have the trend lines and EMA on your price chart, first, watch for an early indication of a setup with a break of the shorter-term trend line. Price breaks the short-term trend line downwards, which alerts us to a potential short setup. Second, price should break below both the moving average and the longer-term trend line. The order doesn't matter. Price breaks the short-term trend line downwards, which alerts us to a potential short setup. Third, traders can enter on close or sell stop the low of the trigger candlestick. Fourth, place the stop loss at the recent high point. As you've seen from both examples, these signals are highly reliable. The key is to identify two trend lines, a long-term trend line and a short-term trend line. Remember, these trend lines must be clear and not forced. Let me give you another example. In this chart, you can clearly see two trend lines, a long-term one and a short-term one. As per this trading strategy, we also include a 50-period EMA line to confirm trend reversals. In our current scenario, first, look for an early sign of a setup by breaking the shorter-term trend line. When price breaks the short-term trend line downward, it signals a potential short setup. Second, price needs to break below both the moving average and the longer-term trend line. The sequence doesn't matter. Breaking below both the moving average and the long-term trend line confirms that the trend reversal may have started. Third, traders can enter a sell order at the closing price or set a sell stop order just below the low of the triggering candlestick. Fourth, set the stop loss at the recent peak. Fifth, exit the trade when the price breaks above both the moving average. These steps outline a clear approach to trading using trend lines and moving averages for effective decision-making. So, trend lines are essential tools in classical technical analysis and are used by almost all traders because they are easy to draw and very effective. However, they can also lead to confusion among traders due to a few reasons. First, trend lines often need to be redrawn frequently. Second, breakouts can be either false or true. Third, there can be an overwhelming number of trend lines drawn using extreme points. As a result, drawing a reliable trend line can be challenging for both experienced and new traders. The Auto Trendline Indicator offers a solution to this issue. The Auto Trendline Indicator identifies and plots the most reliable trend lines on the chart. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. As I mentioned at the start of this video, if you want to master trendline analysis techniques, this video I'm pointing to with the arrow is the best source for you to watch. It covers everything you need to know to grasp all the key aspects of trendline price action analysis and trading strategies. Moreover, you'll also need a trendline tool to help you analyze trendlines quickly. That tool is called the Auto Trendline Indicator.